Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage-Eitel.
All right, my name is Mark-Eitel. This is the Mr. Mortgage Show, and buckle up, Buttercup. We have an awesome show lined up for you this week. My God, all of the craziness that's happening in the stock market and in banking. I've gotten so many questions about it. We're going to dive into all of that this week. Hey, but before we do, I want to share a nursery rhyme for Mr. Powell. Tick-tock, bank stock. Thank you, Chair Jerome. It's crazy out there, guys. I've had so many questions about what's happening with the banking industry and how that's going to affect real estate. There's still a ton of interest in buying real estate, but now, in addition to worrying about interest rates and prices and the inflation pressures, there's a whole new feeling of unease because here we go seeing the headlines, right? Bank bailout, 2008 all over again. And there's about 100 people on social media I'd love to grab by the scruff of the neck and slap some sense into them, because it's interesting how everybody will latch on to the latest, greatest, and oftentimes the scariest headline and start running around out there talking a little bit about what's happening and spinning it into all of this disaster news. So guys, I'm not saying that this is not to be concerned about. Absolutely not. We need to watch closely. But I do want to talk about how it directly affects the mortgage space and real estate, because a lot of people are under the misconception that what tripped Silicon Valley Bank up, SVB, was the investments they made in mortgage-backed securities. So the headline started, and we stayed out of this conversation last week, guys, and we did that on purpose because I wanted to let all the dust settle and let the emotion leave the space, because you hear me say it all the time. Logic and emotion can't live in the same brain at the same time. And if you have any interest in social media, you know that to be the case, because there was some crazy rhetoric being thrown around out there. But guys, now we're going to jump in, and I want to talk about what happened and why it happened as it relates to real estate. I'm not going to talk about the politics and Dodd-Frank and fractional banking and them over leveraging themselves. What I want to talk about is the risk class of the asset that they invested in, which was treasuries and mortgage-backed securities. And the headline that I saw that really, really infuriated me was mortgage-backed security investment coupled with the bank bailout. Here's 2008 all over again. And I don't remember exactly what it said, but that was the spirit of all of it that was being tied together. And it scared the heck out of a lot of people. So guys, the way banking works is if you make a deposit, that bank is paying you interest. They've got to go out there and earn money. That's actually a liability to them when you give them that cash, because now they've got to give it back to you plus a little bit more. Well, the only way the bank can make money is if they either invest it, as SVB did, or they loan it to other people at a higher interest rate. So if they take your money and give you 1% for round numbers, and they charge somebody 2 or 3% to borrow it, now they're making a profit. Well, that works. That equation works as long as you don't need your money back. So keep that little point in mind. Let's kind of put a pin in that because we're going to come back to it. The other way they make money is by investing it in other types of securities that will give them a safe, reliable return. Well, one of the safest asset classes in our economy are bonds, treasuries, mortgage-backed securities, that type of product where you say, okay, for the 60-month period or the 72-month period or the 48-month period of this investment, I'm going to realize a 2%, 3%, 5% gain. They're not sexy gains because they're safe, right? So what SVB did was at the wrong time, because interest rates were at historic lows, they went out there and they dumped a bucket load of money in these treasuries and mortgage-backed securities when rates were under 2%. That's super important to remember. They weren't risky investments. They just weren't paying a big, sexy return. Well, a lot of people are poking fun at them for doing that and blaming them for doing that, but that was at the exact time that Fed Powell was saying inflation is transitory. We're not worried about it. So if inflation's transitory, we don't need to crank up interest rates because there's nothing that we're trying to cool. They're cranking up interest rates to cool inflation. So the big smart people told the whole world there was no inflation to worry about. So the big smart people at SVB ran out there and bought a bunch of these under 2% investments. I guess it was 1.7 was the latest I read. And guys, this isn't a detailed description. I'm just giving you an overview. So what happened was interest rates start going up significantly. It starts to cost a lot more money to borrow money. So the big companies that had a lot of money in SVB stop borrowing as much money and start using some of their cash on hand. That's also important because it diminishes the liquidity position at the bank, and they're starting to have to give money back to some of their customers. Not because the bank was in trouble, because it was more prudent to use cash on hand than borrow at 5, 6, or 7%. So we've got that piece. So they've got a lot of money tied up in a low interest bearing vehicle. So when the when the customers start to draw down the accounts, that triggered a tripwire, if you will, that now they've got a liquidity event. They need some more liquidity in because a bank can't be upside down past a certain percentage. They need to keep, the government monitors the banks. That's why they're able to come in and shut a bank down. They monitor how much cash on hand versus how much outstanding investment, debt, other obligations, because in the case of a run on the bank, they need to have enough cash. So this was happening. And the big smart people at SVB said, we need a liquidity injection. We're going to sell a piece of the bank. Well, as soon as that word hit the street, it scared the heck out of everybody. So more people started drawing down their accounts. So logically, you just go sell all those treasury bills, right? You sell all those mortgage-backed securities. Well, guys, they're not a sexy investment right now because they're paying less than 2%. So if I've got $1,000 and I can loan it to SVB or I can buy their bond for less than 2%. I can buy that, or I can go buy a brand new one just issued today for 4 or 5 or 6%. Where am I going to go? I'm going to go get the higher interest yielding investment. So the only way that they can gain liquidity from those positions are sell them at a loss. If you sell me that bond for $800, then my net gain is a plus. I'm going to buy that lower interest rate bond at a discount, so my gain is realized as a new investor. So that put more pressure on the value of their liquid or near liquid assets. So that's what happened, guys. Investing in the mortgage-backed securities wasn't what tripped them up. It was the time that they invested in them, coupled with the Federal Reserve cranking up interest rates to a point that it became less attractive for the banking customers to borrow from the bank. They started pulling their money down, which tripped a liquidity requirement or a liquidity event. So guys, that's what happened. And here comes the FDIC. They ride in, they shut the bank down, and now they're looking for someone to buy it, another bank to buy it and manage it. That's what happened, guys. It has nothing to do with the quality of the mortgage-backed securities. And that's the part that I just wanted to stress today, is there were too many people running around out there saying that this is evidence that we're in 2008 all over again because the mortgage-backed security piece is becoming undervalued or a risky investment. And I just wanted to touch on that. So guys, thank you for allowing me to do that. If you've got questions regarding that, we can dive really deep on it if you wish. Call, text 855-462-7292. That's the Anytime hotline. 855-462-7292. Jen is standing by, womaning that hotline. I know she's already back there getting some questions, so I feel like we've got an awesome show on deck for you. If you prefer to hit us via email, go to mrmortgageradio.com. Scroll to the bottom of the page. There you'll find the email icon. Click on that icon and send us your question that way. Guys, sit tight. You hear the music. You know what that means. That's my cue. We'll be back in a few. On the other side of this break, we're going to dive into your questions and continue on with the Mortgage Mayhem. Thanks, guys. We'll be right back. Hey, it's mark-eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you have any friends or family or coworkers who are thinking of buying or selling or refinancing real estate, I'm hoping I can count on you to introduce them to me, to the team, to the show. We'd love to help them any way we can. Just simply share the link, mrmortgageradio.com, mrmortgageradio.com. Again, it's mark-eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is mark-eitel. You are listening to the Mr. Mortgage Show. Thanks so much for letting me open the show with that SVB diatribe. I hope that answered some questions. I know I didn't dive into Dodd-Frank. I didn't dive into leverage banking because none of that's important to my point in sharing that. What was important was a lot of people on social media were mischaracterizing the investments that were made as risky and associating the mortgage-backed securities as the cause of the problem and then insinuating that that is going to trigger or is at least an indicator of a potential downturn in the housing market, because everybody remembers last time mortgages led the housing market down, which pulled the economy down. And there are a lot of people out there that are trying to grab onto that coattail, and that's not at all what happened or why it happened. So if you missed that and you want to catch it, if you're just joining us, give it a couple days, but Jen will post this radio show up as a podcast to mrmortgageradio.com. So guys, we're going to dive into your questions. If you've got questions, just call or text 855-462-7292. That's 855-462-7292. As I mentioned, Jen, my producer, she is standing by, womanning that hotline. She's jumping around back there. We've already gotten some questions coming in. If you prefer to shoot us an email, just visit mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page. You'll see an email icon. If you click on that, you can shoot us your questions via email. Speaking of your questions, let's dive right in. Hey, Jen, do you have one ready? Okay, go ahead.
Patricia is asking, is it possible to get a reverse mortgage on a home in foreclosure? My dad is in a tough spot, and I don't know if selling is his only option. Thank you.
Hey, Patricia, thank you for that question. Man, I'm sorry that your dad is in this position. But I got to tell you guys, we are seeing more and more of the fixed income senior community just being stretched so thin by this inflation that sadly it doesn't surprise me. And I know a lot of people went into that payment moratorium during COVID, and some people came out unscathed and others are struggling to get back on track. So to answer your question, yes, there is the availability to do a reverse mortgage on a property that's currently in foreclosure. There's a lot that I need to know. There are several caveats to that answer. You know, the main thing being that there is enough equity, because the lender is going to take a portion of that equity and set it aside in an escrow account for future payments of taxes, insurance, and if there's an association fee, to make sure that those are being paid. Because whether this is a fault of your father's or not, in foreclosure, the lender identifies that the ability to manage those monthly expenses are no longer being met. So they meet those by setting aside an escrow account with those expenses. So assuming that the money is there in the form of equity, then yes, you can do it. But you mentioned that he's considering selling. If selling is his goal, there might be some other opportunities. And here's one to consider. And I don't know if this would work, but the higher interest rates may work in his benefit if he was to sell the property and hold the mortgage, as if there's enough equity to accept a down payment, let that down payment pay off the loan that's in foreclosure, and then collect a monthly mortgage payment, if you will, from the new buyer. So we've seen that work in the past. And guys, one thing that's super interesting right now, a lot of people are hearkening back to 2008 and saying, here we go again. And you know my thoughts on that. I just spent 10 minutes on the other side of that break sharing those with you. But it's interesting because last time nobody had any equity. This time everybody, well, that's not true. Not everybody, but a lot of people have equity. Heck, I read a statistic the other day, or actually it was shared by a friend of mine. I was in a mastermind and we were having a conversation about this very thing. And he shared with me a statistic that he had found that nearly 40% of U.S. households don't even have a mortgage. So what an opportunity for somebody to leverage these higher interest rates as an income strategy. And I'm not suggesting that's the right move for your dad. I know you called asking primarily about refinancing a reverse, but that definitely can be done. We would just need to uncover a few more details. And then lastly, don't forget the opportunity to do a reverse mortgage to purchase. So if he wanted to move, be closer to the family, whatever the case may be, that could be an option as well. And I talked a little bit about that last week, but I'm happy to spend as much time with you as you need to kind of figure all this out for you and your dad. And guys, I know on the surface, some people have an adverse reaction to even the term reverse mortgage. The official term is HECM, HECM. Home equity conversion mortgage is what it's called, but they're not the dangerous tool that was abused in the past. There's been some new rules put in place, but used correctly and for the right person, it can be life-changing. And guys, you've heard me say it before. It's just a tool, just like a hammer. A hammer can be used to build a house. That same hammer can be used to tear down a house. And a reverse mortgage in the wrong hands, in the wrong circumstance, can be detrimental. So I just wanted to throw that out there. It sounds like his back is up against the wall and this might be the last option. And I'm happy to walk you through it if you think that that would work for him. But to answer your question, that was a long-winded answer, but to answer your question, yes, you can do a reverse mortgage on a property that's in foreclosure, assuming all those other caveats are met. So, hey, I'm going to toss it over to Jen and see if we can squeeze in another question. Hey, Jen, what do we have?
Monica has this question. With what is going on in the economy, we're thinking we should buy a couple rental properties. What are the typical down payment requirements and interest rates for an investor mortgage?
Hey, Monica, that is a fantastic question, and you are not alone. I've fielded many calls this week about this very, very topic. So it's super interesting. A lot of people were scared when they saw how quickly a paper asset can disappear. And by that, I mean, typically a deposit above $250,000 is not insured by the FDIC. And I know in the SVB circumstance, they're insuring all of the deposits, but it shook a lot of people up to think, my God, all that money could have just disappeared. So several people I've talked to are looking at physical assets, right? Precious metals, real estate. I mean, even art and jewelry people are talking about. So I find it fascinating that whenever there's kind of this big shakeup and everybody's slapped with a dose of reality, suddenly we start looking at these alternative strategies instead of just parking some money in the bank. But to answer your question, typically 15 to 20% down payment is required. And then the interest rate could be 1.5% to 2.5% higher than a conventional purchase. And I'm using that as a rule of thumb because rates have been moving every day and moving considerably, kind of bouncing around up and down. So I don't want to misquote a rate. And it's all specific on the property, the credit score, the loan program. But that should give you a good guide of what to expect. Some of the investment loans have the interest-only period where you can pay interest only for the first 10 years, and then it becomes a 30-year fixed-rate mortgage. Not like the dangerous interest-only loans of the past. Again, I said that as soon as I said it out loud, I'm like, okay, here's another reference to 2008. Guys, they're very, very different. But I just wanted to make you aware of that because that maximizes the cash flow generation in that first 10 years. So, but that was a great question. You are not alone in the flight to safety. Suddenly everyone's looking at precious metals and real estate and all of that physical asset classification. I even talked to one guy who's buying art and Rolexes, which I found pretty interesting. But guys, sit tight. You hear the music. You know what that means. That's my cue. We'll be back in a few. On the other side of this break, we're going to dive into more of the data, take your questions, and continue on with the Mr. Mortgage Show. We'll be right back.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is mark-eitel, and you heard the man. Call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen, my producer, is standing by, womanning that hotline. She'll get you on the air. 855-462-7292. 7292, or shoot us an email by visiting mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click the email icon, and you can shoot your questions over that way. And guys, thank you for your questions. We started the show off with some really, really good ones. I appreciate that. But let me throw it over to Jen, and we will keep them coming. Jen, what do we have?
Felix sent this one. I hear a bunch of real estate people saying this is not 2008 and it's still a good time to buy. But it's starting to feel like 2008 to me. We are still looking, but I'm not sure if now is the time. Do you have any advice?
Felix, you just heard me say that too. It's not 2008. I guess we need to come up with some new phrases, right? Those phrases drive me nuts. The whole date the rate, marry the house. Oh, I just said date the rate. It's not 2008. I don't know. But I do think it's a good time if it's a good time for you. And what I mean by that is we get so wrapped around the axle focusing on the price of the house, focusing on the projected value, if you will. Is it going to go up? Is it going to go down? Focusing on the interest rate. And we forget to focus on the most important thing. We're looking at appreciation, we're looking at the price, we're looking at the interest rate, but we forget to focus on our budget because that's the only number that doesn't change. When we do a mortgage approval, we're not approving somebody for a $500,000 house. We're approving them for a $3,500 a month payment. Now, if rates go up, the amount that you can borrow for $3,500 a month goes down. But if rates go down, it goes up. So I get it. All of those other numbers are certainly important, but the focus number is the budget. So to answer your question, if the budget makes sense for the properties that you're looking at, if you can comfortably make that payment, and guys, just because you're approved for $5,000 doesn't mean you should spend $5,000. I'm a big advocate of living below your means. Live comfortably. You're entitled to everything that you want if you can afford it. But don't stretch yourself to a point that you're not comfortable. So I'm a proponent of working underneath the budget every possible chance that I have. So I always focus on that number. So to answer your question, if you can find a property that you want to make your home and that budget makes sense, I still believe it's a good time. And I'm going to tell you why. We did this, 2, 3, 4 weeks ago on the air, and you can go check out mrmortgageradio.com and find the podcast replay. But we took the property values in this country from 1940, and I went back to 1940 because that's the only data I could find, but we went decade by decade, 40 to 50, 1950 to 1960, etc., 60 to 70, all the way up to 2020, because that was the last data set I could find. And not one time, if you take decade jumps, did we see a downturn. Now, there were years of downturn, but not decades. And during those time periods, we were at war. We had Democratic presidents. We had Republican presidents. We had high interest rates. We had low interest rates. But decade over decade, real estate outperformed all of those other distractions. And it made sense to own real estate. And lastly, guys, even if real estate doesn't appreciate, you gain equity by paying down the principal. And until you can figure out a way to live for free, it's not an expense that you really have a choice about. You're going to pay rent or you're going to pay a mortgage payment, unless you're living in your mom's basement. And then, man, be nice to that woman, help her with the dishes, do the grocery shopping, because you're not going to find a cheaper place to live than mom's basement. Come up from the basement once in a while and help out around the house so she doesn't boot you. But no, I'm kidding in that respect. But what I just want to encourage everybody is to focus on the budget, because watching the rates, man, I watch them all day, every day, and it makes me crazy. I could imagine basing my entire decision on the interest rate. And I don't know where you are in the country, but I'm born and raised in Florida, and I remember sitting on the beach watching the tide come up and go down. It doesn't go up or down in one straight line, not one big wave, and here it is, now it's up. A wave will come up, it'll go back down, it'll come up a little farther, it'll go down a little less, and it'll march in that step pattern up and down. And if you're trying to watch the interest rates to make a decision, man, it moves up and down every day. So is it a good decision on Wednesday, but a bad decision on Thursday? I think that's the wrong number to look at. And I'm not suggesting that's what you're looking at. Your question was, is it still a good time to buy? And my answer is, if the budget makes sense for you and you want that home, you want to raise your family in that home, that's a place you want to live, that's a community that you want to be a part of. I think historically, all of the data has proven that homeownership builds wealth. And guys, we had a question a minute ago about a gentleman who's later in life in foreclosure, but he's got equity in his property. So he's got access to that via a reverse mortgage, via selling the property and cashing out that equity. Had he remained a renter his entire life, he would not have that equity to help bail him out of this financial circumstance. So there was a statistic published, I think it was 2019, 2020. The average, and somebody will correct me if I'm wrong, the average homeowner in this country had a net worth position rather, of $250,000 or better, and the average renter was around $6,000. So it makes sense to own a property. It might be hard to get your mind around the price considering how quickly it's increased. It might be hard to get your mind around the interest rate since a year ago it was 3 and 3.5%. 18 months ago it was lower than that. But focus on the budget because you're already paying that money to someone for the privilege of living in the property they own. And that's a whole nother conversation. If you move later, you choose to move up or over or to a different city, you can hold that property and let somebody else pay it off for you and help you create that wealth. And guys, we've never talked about the need to create generational wealth in this country more than we have in the last, 3, 4, 5 years. And real estate is probably the easiest way to do it. Let me rephrase that. The simplest way to do it. Buying real estate's not easy. You've got to go through hoops. You got to get yourself ready. You've got to save up some money. Even if you use 100% program, you've got closing costs. There's no free lunch, if you will. It's not easy, but it's simple. It's a simple process to generate long-term wealth. And there's no other way to say it. Yeah, you can make more money on Bitcoin. Yeah, whatever the latest, greatest stock investment is might be sexier. But just building equity over time has proven itself as a worthy endeavor. And this is not an expense that you can avoid. It's not like you're cutting out your Starbucks or you're not going to the movies. If you're paying $1,500 or $2,000 or $2,500 a month in rent, if you go out there and you pay that equivalent amount in the form of a mortgage, you are doing yourself and your family a huge service for later in life. So anyway, I got a little long-winded because it's hard for me to sit by idly and watch people distract themselves because yes, I do believe it still makes sense, but it's got to make sense for you financially. It's not, I wouldn't speculate on real estate right now. I wouldn't want to do a short-term flip or wholesale out of contract unless I found a distressed property. But if I was buying a property to we're looking at properties. Let me just say that. I'm looking at properties every day for me. So, yeah, I do think it's still a good time. But there's a lot of moving parts around that, and I hope I addressed all of that. Thank you for indulging me that. Anyway, that was a brilliant, brilliant question. I do appreciate it. But guys, you hear the music? That's Jen's way of saying, Mark, get off the soapbox and stop talking. We got to jump into a break. That's my cue, guys. We'll be back in a few. Sit tight. On the other side of this break, we'll be back to take more of your questions and continue on with the Mr. Mortgage Show. Sit tight. We'll be right back. Hey, it's mark-eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you have any friends or family or coworkers who are thinking of buying or selling or refinancing real estate, I'm hoping I can count on you to introduce them to me, to the team, to the show. We'd love to help them any way we can. Just simply share the link, mrmortgageradio.com, mrmortgageradio.com. Again, it's mark-eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into my very favorite real estate and mortgage show, the Mr. Mortgage Show, and hopefully it's becoming yours too. Guys, if you've got questions, call or text 855-462-7292. That's 855-462-7292, or visit mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot us your questions via email. But speaking of your questions, I know Jen's got some more questions ready to roll over there, so let me toss it her way. Hey, Jen, okay, what do you have?
Susan sent us this one. Do you think what's happening with the banks will make it harder to borrow money in the future? We will be moving in the fall, and I'm getting a little nervous.
Okay, that is a brilliant question, and I do not have a crystal ball, but I don't see a negative impact on available capital for mortgage lending at the moment. So, guys, you may or may not know this. This may or may not be interesting, but more lenders lend money, and then they securitize. They put all those loans in a big basket. It's called a tranche. And then they issue securities against those loans. So they'll sell you a bond that's guaranteed by the loan, right? That's how they're paying the bond back. A mortgage-backed security, it's called. So right now, there's still an appetite for that recapitalization component. There's still people buying. There's still institutions. There's still governments. There are still investors buying those mortgage-backed securities. That does not have a direct impact based on what's happening in the banking environment at the moment. Now, something could change, but right now the quality of the loans and the interest rate that they're being sold at is still desirable for investors, and that's the component that provides the liquidity, because every time the bank loans money, once they get to a certain point, they take all those loans and sell the mortgage-backed securities against them so they can recapitalize and lend more money. And at the moment, that does not appear to be interrupted. But brilliant observation. Good on you for looking that far ahead. So I hope that answers your question. If you need more info about that, or if you want someone to talk to when you're ready to get started, we are here and always, always happy to help. So I appreciate that one. Hey, Jen, do we have another question?
Lennox is asking, I'm actively looking for a house. We've even made a few offers, but I just got offered a new job with a competitor. It's a bigger company and will pay better. If I take the job, can I still get a mortgage, or will I need to wait for 2 years?
Hey, Lennox. Brilliant question and fantastic name. That's a very cool name. I haven't heard Lennox since Lennox Lewis, the boxer back in the day. But anyway, great name and great question. So to answer it, it depends. If you are taking a salaried position and you're currently salaried, that's not a problem. Do it as soon as possible, though, so that it's easy to document that transition. You mentioned that you're not yet under contract. So if you're going to do it now and then start the approval process. But you're not going to need to wait 2 years. If you're, the manager of a company X and now you're the manager of company Y, and you mentioned it's an increase in pay, which is awesome, and you're getting paid, W-2 to W-2, then it's not a problem. Where it becomes a challenge, and you hear that 2-year rule, is if you're going from, you manage a service company and now you're going to go sell for a competitive service company on a 1099, you haven't established a consistent income, a verifiable income as a commissioned employee. Now you're going to be in the position to have to wait 1 to 2 years. And I say 1 to 2 because sometimes it's as little as 1 year, but assuming that you're getting paid the same way, and you mentioned it's a competitor, so I'm guessing a similar position in a similar company, you should be okay. But if you want to talk through that before you make the move, give me a call. I'll be happy to walk you through it off the air. I'd like to ask a few questions. I'd need to know a little more. Are you getting a bonus now and that bonus structure is not there? There's certain things that you're going to want to give some consideration to make sure that your pay package, it doesn't have to be the same. It's great that you're getting a raise, but that the way you're getting paid and the duties that you're performing are similar, so that your history with the former employer, your current employer, I guess, because you haven't left yet, can carry forward, and you're not going to have to start from scratch with that new employer. I hope that answered that question. That's a good one. We saw a lot of that during the pandemic as people were, moving around and making some significant changes, and where it became a challenge was if they were going into a commissioned only type of position where they're now getting paid on a 1099, and we've not established that income that verifiable income pattern as a commissioned person. So brilliant question, and good on you for considering that before you take that job. So I hope that helps. But hey, Jen, do you have another one?
Terrence sent this text. What is the normal down payment for a first-time buyer? Also, what minimum credit score do I need?
Okay, something's fishy here. We just had Lennox, who was a British boxer, and now we've got Terrence, and my mind goes to Terrence Trent D'Arby, who was a British singer. I don't know what's going on. Is this the British invasion all over again? I love it. That's very, very, very cool. But anyway, to answer your question, there are some programs that require no down payment. There's the USDA is no down payment. There are grant programs that you can couple with the FHA loan to get to 100% financing. The seller can pay closing costs with that program, so you can get in with very little money out of pocket. I mean, there are a lot of programs out there right now. Some are specific to first-time buyers and some are not, but a variety of programs. But let me give you the kind of rule of thumb generic answer. So FHA loans require 3.5% down. Conventional has a program with as little as 3% down. So if you went into this and you didn't qualify or weren't interested in one of the grant programs, then 3 to 3.5% down payment, and both of those loans can allow the seller to help with closing costs, but you do want to factor in the closing costs into those equations. And guys, there's a great mortgage calculator that does all that for you. If you go to mrmortgageradio.com and scroll, I think it's tabbed out as mortgage calculator, but mrmortgageradio.com and hit that mortgage calculator button, it'll help you figure out all of that. So if you find that useful, let me know. And if you need more information, I'll be happy to jump in and help. But I hope that answered your question. It's a good one. And to credit score, I guess, before I move on, FHA, you can go down into the 500s. Obviously, the higher the credit score, the easier it is to go through the process. But the FHA program will allow you a credit score in the 500s. The conventional programs, you're going to want to be, 620. Some of the grant programs, 640. The higher, the better from an underwriting standpoint. And oftentimes with the lower credit scores, it's not necessarily the score that is the challenge. It's what's pulling the score down, right? There might be recent repossession of an automobile, some late payments on credit cards, a former foreclosure, but you mentioned you were a first-time buyer, so that wouldn't apply. But I'm just sharing what we see with the lower credit scores. Oftentimes, it's not the score itself, but it's what's pulling the score down that needs to be considered. So I hope that answered your question. That was a good one. I certainly appreciate you shooting it over. And if you need more information, please reach out. We're always here and happy to help. But Terrence, you hear that music? Not Terrence Trent D'Arby music, by the way, which was pretty cool. Should we go out singing some of that? Sign your name across my heart. I want Jen, she's leaving the building. She hates it when I sing. Guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is mark-eitel, and you are listening to the Mr. Mortgage Show. And guys, if you've got questions, 855-462-7292 is the Anytime hotline. You can call or text that number, 855-462-7292, or check out mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page. Click that email icon and you can shoot your questions over to us via email. And I know we've got a couple more over there, so let's try to get through them. Hey, Jen, what do you have over there?
Rhonda is asking, we'll be buying a rental property and would like to add my daughter as a co-borrower. This is so she'll end up with it when her father and I die. She doesn't own a home yet. Will this create a challenge for her when she's ready to buy a home?
Hey, Rhonda, that's a great question. And guys, one more person out there looking at rental property in this tumultuous economy. So I'm feeling really good about the real estate as a physical asset right now. And Rhonda, to answer your question, no, that will not prevent her from applying for a loan. Here's where you just want to be mindful. You want to report the income from the rental property on your tax returns. So a lot of people get wrapped around the axle and they say, well, we're not really making any money, so I'm not going to report it as income. Well, guys, every dollar that you collect as rent is income. You might have adequate expenses against it where you're not paying income tax on that money. And if you depreciate the asset, you could even have tax benefits of ownership. But you want to claim that income, because if that income's not showing up on a tax return, there's no way to use it as income when she goes to apply for her primary residence later and they see that on her credit report. She can say, wait a minute, that's a rental property. Here's the rental income. So that won't be counted against her. And one thing to consider, listen, I'm not a tax attorney. I'm not a CPA, but I recommend you speak to one of those two professionals. I see a lot of people doing this with an LLC. And that landlord loan that we talk about all the time, you can close in the name of an LLC, but that way the three of you could be members of the LLC and she could have ownership interest in it that way, and the LLC is the borrower. So that might be an option as well, but brilliant question. I'm going to keep the questions rolling because I want to get through all of them. So, hey, Jen, can you throw me another one?
Lori has this text. I'm a real estate agent, and my client's bank is saying they are subject to new guidelines and their down payment requirement has changed. Are they allowed to do this after they've been approved? They haven't found a house yet, but this is going to change what we are looking for. It just doesn't seem right. Can you help?
Oof, that's a tough one. Here's the thing, right? If they've not been rate locked, fully underwritten, they're just in that approval process and something guideline-wise changes, then yes, they could be subject to different guidelines. But here's the challenge. I'm not aware of any guideline changes, and I read the Fannie and Freddie releases almost every day. At least I look for them. There's not a release every day. So it's interesting that you use the word guidelines, because I don't know of a significant guideline change that's happening right now. Now, there's some pricing changes. There's what we call LLPA, loan level pricing adjustments. There were new LLPAs that were just enacted, and those are happening right now. So what could be happening is they're subject to a higher interest rate, and to keep the payment the same, they might have to put a larger down payment down. That's one thing that might be happening. Another thing that could be happening, and this is where, if it is, we might be able to jump in and help, is that sometimes banks put what's called overlays in place, and they'll mistakenly refer to that as a guideline. But an overlay is a temporary, often more restrictive guideline that a single bank or a single lender is putting in place on their portfolio because they don't want, here's an example. Freddie and Fannie, right? They write the guidelines. And if we underwrite a loan and a bank funds a loan, or we as brokers originate a loan to those guidelines, they're saleable to the GSEs because it meets the guidelines. Well, during COVID, the banks were nervous and they're like, well, I don't know if we're going to fund against manufactured homes. Here's an overlay. Here's a temporary, more restrictive guideline, if you will, but it's really an overlay. So if that bank just put some overlays in place because they want to pump the brakes on a certain type of loan, a certain type of property, because they're exposed to too many townhouses or manufactured homes or whatever it is, condos in Florida, and they're pumping the brakes and saying, okay, we're putting a temporary, more restrictive guideline in place, and it's just that, it's an overlay, then someone like me can jump in because we've got access to over 100 sources of funds and originate and close that loan to the original guidelines. So I would need to know a lot more. I'm sorry that you're going through this. I mean, sometimes it feels like the banks make all the rules. I totally get that. I fight every day for our borrowers, so I understand your frustration. If you'd like to have a conversation off the air to see if there's something we can do, I'm happy to jump in. I appreciate you having enough confidence in me to shoot us that question. But I would ask the bank, is it a guideline? Is it an overlay? Or is it a debt to income issue because of a new loan level pricing adjustment? And I know all that's confusing lingo for the average person, but you said you're an agent, so I'm sure you get it. And I hope that helps. Let's talk off the air and I'll walk you through it if I can. Hey, Jen, can we squeeze in some more questions?
Carter sent this one. I listened to you talk on YouTube, and you briefly mentioned watching the rent gauge as an indication of a downturn in housing. Can you explain this? Thank you.
Hey, Carter, thanks for that, my man. I appreciate it. Somebody found us out there on YouTube. You had to blow the dust off that channel because no, I'm kidding. But if you saw me on YouTube, you know I definitely have a face for radio. So I appreciate you sitting through that. I don't remember, the rent gauge thing is not a term that I use often. I think what I most likely was talking about is watching average rents as a gauge to see if home values are supported at these prices and these interest rates. And what I mean by that goes all the way back to that earlier question that we had about buying right now in this environment. And I really lean on that budget number. Let's say, for example, you can go rent a house for, well, here's a perfect example. I've got a friend of mine. He's on an airplane right now flying down to Panama, and he's looking at real estate, and he's showing me these beautiful homes. And I said, how much is that house? Well, it's $450,000. Well, I mean, it was amazing. Here, that would easily be $1.5 million, $2 million, depending on where in the country it was. It was beautiful, maybe even more. It was overlooking the mountain. I mean, it was an amazing house. He wants to buy the property and rent it out until he can move down there permanently later in life. And I said, that's awesome. What is that rent for? And he said $1,500 a month. And I said, well, you're never going to pay $450 for a house that you could rent for $1,500 a month, are you? And he said, absolutely not. I'm going to go down there and sign a lease for $1,500 a month and put my $450,000 to work, making me enough money to pay my $1,500 a month rental costs. So that's what I'm talking about. If you look at a property, could you rent it for less than you could buy it for? And if that gets out of balance and renting becomes cheaper, then more people might be satisfied renting. If it's a push, or even if owning is a little bit more money, it makes sense to buy. But that's what I'm talking about, where I'm saying gauging the cost of rent versus where home prices are. So anyway, I'm sure that's what it was. I hope that helps. And thanks again for checking us out on YouTube. Hey, Jen, do we have time for another question? Can you throw me one more? Okay, what do we got?
Rebecca sent this one. We've been trying to catch a dip in the mortgage rates so we can start the refinance process. One day we see them down and then they jump up again. What should we be looking for? Thanks for your advice.
A crystal ball? No, I'm kidding. That's a brilliant question. So you're a little bit ahead of the game to try to grab a rate lock because you're not yet in the process. So go ahead and start the process, get approved. So your approval is there, your deal is pending, and you're just waiting to lock the rate. That way you can move on a moment's notice. If you get a midday dip, you can lock the rate and move forward. So first step is get into the process, get your approval in hand, and then watch for the rate. My second piece of advice would be go ahead and establish your target rate ahead of time. And then once you hit that target, pull the trigger and don't look back. Because let's say, for example, your target rate is 6.25 and you get a dip to 6.25. The last thing you want to do to yourself is say, well, let's see if we can get 5.99 or 6. And then rates move in the other direction. And now you've cost yourself that opportunity that you worked so hard to get. So get approved, set your target, and then when you see the target, pull the trigger and don't look back. That would be my advice. And brilliant question, by the way. Hey guys, you hear that music? You know what that means? That is my cue to wrap up another week here at the Mr. Mortgage Show. My gosh, where does the time go? I have so much fun on the air with you. I know Jen has fun with you too. So guys, we'll be back here next week, same time, same station. If you need us during the week, all of our information can be found at Mr. Mortgage Radio. That's MrMortgageRadio.com. One more time for the kids in the back, MrMortgageRadio.com. Have a fantastic week. Jen and I will be back here, same time, same station, next week.